This episode is going to look at the units of production method to calculate depreciation expense. Recall that there are three methods to calculate the cost of depreciation each accounting period. The first was the straight line method, which we looked at in a prior video. Now we're going to look at the units of production method. Remember that regardless of which method we use to calculate depreciation expense, the adjusting entry is always the same. We will always debit depreciation expense and credit accumulated depreciation, which is the contra asset account. To see the use of the units of production method, we're going to look at this example. On December 31st, equipment was purchased for $50,000 in cash. The equipment is expected to produce 100,000 units over its useful life and has an estimated salvage value of $5,000. If 22,000 units were produced during year one of this asset's life, using the units of production method, we're going to calculate the amount of depreciation expense. The formula to calculate depreciation expense under the units of production method is to take the asset's cost, subtract out its residual value or its salvage value, and divide by its total estimated useful life. But instead of using the number of years as the estimated useful life, as we did in the straight line formula, this formula uses the total estimated units to be produced over the life of the asset. So we estimated this machine or this equipment would produce 100,000 units over its life. So cost minus salvage divided by total useful life production, we end up with 45 cents per unit. This is what we call the depreciation rate to record per unit. So to get each year's depreciation expense, we are going to multiply that depreciation rate per unit times the year's actual production. In year one, we actually produced 22,000 units with that machine. So the actual units produced times the depreciation rate per unit, we are going to record $9,900 of depreciation expense in the first year of this asset's life. The journal entry, just as it was under the straight line method, is a debit to depreciation expense and a credit to accumulated depreciation. Using the units of production method, the amount to record is $9,900. So we're seeing in the first year of this asset's life, depreciation expense recorded is $9,900, bringing the balance in accumulated depreciation up to $9,900, and the book value, which is the difference between the asset's cost of $50,000 and its accumulated depreciation, brings the book value down to $40,100. Assuming that in the second year of the asset's life, 28,000 units were produced, we would take year two's actual production and multiply by 45 cents per unit to get the depreciation expense to record in year two. So in year two, the journal entry would be debit to depreciation expense and credit to accumulated depreciation in the amount of $12,600. In the third year of the asset's life, it didn't produce anything. Because it didn't produce anything, the equipment was idle. And if the equipment is idle, it isn't helping earn revenues. It's not going to incur any expense to help earn those revenues if it wasn't producing. So there is no depreciation expense to record in that third year. Accumulated depreciation didn't change. The book value didn't change because it wasn't used. We didn't have anything to record. In the fourth year, 32,000 units were produced, times the 45 cent per unit depreciation rate means depreciation expense for the fourth year is $14,400. The journal entry, debit to depreciation expense, credit to accumulated depreciation in the amount of $14,400. Bringing accumulated depreciation up to $36,900 and the book value to $13,100. In the last year, 18,000 units were produced, times the depreciation rate per unit of 45 cents. Depreciation expense for the last year, $8,100, bringing the balance in accumulated depreciation up to $45,000, and the book value falls to $5,000. Remember, book value is the difference between the asset's cost and its accumulated depreciation. Even though this asset has reached the end of its life, it has produced the 100,000 units that we expected it to, it still has a value of $5,000 because we expect to be able to sell it for $5,000.